Do what other people aren't doing. In today's episode, we dive in with Kent Ritter into some phenomenal strategies, technologies, and more that you can apply within your own business that him and his firm has been able to apply to really be able to see scale happening. Over $1.5 billion of assets under management. This firm is huge. But they've been diving into the mid-sized multifamily space. They've been leveraging technology, and we get into some personal conversations that I think will really open up your eyes to living a more motivated life. That and more. Let's get right to it. This is the Investor Mindset Podcast. All right, guys, welcome back to the Investor Mindset Podcast. I'm your host, Stephen Pesavento, and today I've got a very special guest. Kent Ritter is in the studio. How are you doing today, Kent?
I'm doing great, Stephen. Thanks for having me.
Yeah, I'm excited to dive into things. And as you guys may know, Kent serves as the managing director at the multifamily private equity firm, Birge Held Asset Management, and creates returns by acquiring and improving mismanaged, undercapitalized, and undervalued properties. He's also the host of Ritter on Real Estate podcast that's available also on YouTube, where he dives into impactful interviews and practical tips for investors. So the firm is doing some incredible stuff. Really excited to dive into that and more. Are you ready to get into things?
I'm ready. Let's do it.
All right. Before we get into what is going on today, I'd love to start out by looking back at earlier in your life. What events or influences from your childhood shaped who you are today?
Yeah, that's a really interesting question. So, a major event in my life, I actually lost my father fairly early. I was 14 years old. He passed in a car accident, and obviously had a huge impact on me. I think just on kind of stepping up to be the man of the house, taking on more responsibility, really wanting to be that kind of provider, even at a young age, wanting to just make sure that everybody was okay and kind of be that rock, I guess. And I think I've carried that mentality through my life in just being kind of wanting to be a source of strength for people, wanting to be, kind of the person that has it all under control, the one that people can go to, that can help them out. So I think that of almost everything, probably had the most impact on my life early on, and just the kind of the ramifications of that, and kind of being put into a position of just really kind of an adult position of responsibility at a very early age.
Well, it's such a difficult thing to deal with. And as a kid, grief is something that is hard to understand. It's hard to understand for adults. People go through these kind of processes, and, it makes you have to grow up pretty early. How do you think that impacted where you are today, based on stepping into that manhood, stepping into being the man of the house, so early in your life? I can relate different reasons, but I'd be curious what your thoughts are.
Yeah. So how did that impact where I am today? I think it's, so one is just an appreciation of life, just an understanding that on a very deep level that it can all be over in a second, and you never know. And so just I think that's given me a drive, to just want to succeed. I guess I've never been one to wait. I've never liked being told that, when I was a management consultant for a long time. And I was one of the youngest directors, if not the youngest director, I'm not sure, in my firm. And to get to that next level, I just remember hearing things like, "Oh, you gotta wait your time. You gotta put in your work. You gotta, blah, 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 pay your dues, all that." Well, I think my perspective that, is just different. I just want it. I want it now. I want to succeed now. You just never know if you're going to get tomorrow. So I think that's one thing, but I think in general, if you're talking broader than business, I think just the appreciation of life, the ability to kind of step back and just appreciate the little moments and appreciate the, like, I mean, even if it's a bad day, you're here, right? You're breathing and you're alive and you're able to keep going. And I think it also really instilled with me a resiliency. You get knocked down and you get back up again. It was like now I sound like a Chumbawamba song or something,
but it's
so true. I think
it's so very true. And it's in those times that are the most challenging in life that it really creates our character, who we are, and gives us that insight. I don't talk about it often, but I lost my younger sister, in a car accident just a little bit before we met over a year ago. And it's that kind of a moment that ends up making you realize what really matters the most. Because within a moment, all of your aspirations of everything you've been working towards, in that moment, all of a sudden, everything you've been stressed about doesn't matter. And that can happen any second of any day. And so I've noticed myself, and you've been living with that lesson for a long time, but I hope the listeners can take it away that it doesn't have to be, obviously it's awful when these things happen, but it's a reminder that we've just got to make the best of whatever moment we have, because we don't know if we have another one. So we better enjoy whatever we're doing today. Yeah.
And I think, and I'll just share this with you because I didn't realize you'd had such a recent loss, but for somebody that's been, 2 years down the road now from that time, it also just a perspective that it does get better, which I think is also just like it's never as dark. Like, you could be in the darkest moment of your life. It's never going to stay that dark forever. Right. I mean, I went through a very tough time after his death with just a lot of anger. As a teenager in high school. Right. But I was able to reach a point of acceptance and just an understanding. And it went from thinking about him and his memory being a painful event to being a joyful thing and being an inspiring thing and actually putting a smile on my face, so it's just, they say time does heal. I mean, time definitely does heal. You also, I think, have to do some personal work as well. But I think that perspective too, that like, no matter how bad it is, like it'll get better. Just stick with it.
I agree completely. Well, thank you for that lesson for myself and for everyone else here. But fast forward, obviously, you're in the multifamily space. You're working with a firm that has, over $1.5 billion of assets under management. You guys are doing some pretty interesting things, right? Typical value add multifamily type strategy. But what I really appreciate from our conversation is that you've gone after some different asset classes that a lot of folks don't focus on. And I personally am invested in some of these mid-sized multifamily opportunities because of the kind of return profile that's available. But I'd love it if you could talk to us a little bit about what that strategy is and kind of open the eyes to some of the listeners to what that looks like and maybe how they might be able to take advantage of that as well.
Yeah, absolutely. So we've been operating, the firm's been operating since 2008. So we've got a track record there and I think it's just a different perspective from folks that have maybe just started, right, or started a couple of years ago and have kind of always been in this hyper competitive market, right? So to us, and especially to our principals who have been in real estate for 30 plus years, seeing where the market is now and the hyper competitive nature of it, I mean, really caused them to want to shift in a different direction rather than just kind of accept it because it's all they've ever known. Because they're saying, things are just out of alignment right now. So all that being said, in 2020, we took a very conscious shift. Really, I would say kind of just added another strategy rather than deviated from the strategies that we're currently doing, but added a strategy very specifically focused on properties that are smaller to mid-sized properties in more tertiary markets. and properties that are largely what I call mismanaged or undercapitalized and undervalued, right? And what that allows us to do is that allows us to buy at better values and therefore provide better returns for our investors, because we're not operating in the hottest markets where, when you go and you bid, you're competing against 30 other people. And when you do that, you're just going to overpay. There's no way to win against 30 others and really buy it right. And so by focusing in the Midwest, which is where we're based, which always has had a better value and higher cap rates, and then niching down into these smaller properties and even going into more tertiary markets where we're comfortable because we have a familiarity, but others who aren't local may not be comfortable, has allowed us to create return profiles today for our investors that most investors would be used to seeing, 4 or 5 years ago. Whereas in the larger deals that we do, because we do these large institutional deals, the returns just continue to degrade because of that, because of cap rate compression, and largely due to demand.
Yeah. Well, it makes sense. And it's a great thing for people to remember about an idea to go where other people aren't, right? Mm-hmm. If all the institutional investors are going to big cities, if so much money is moving from other asset classes like commercial and hospitality into, institutional multifamily, then we have to ask ourselves a better question. Well, where else could we find the kind of returns that we're looking for that give us that security while still being able to create a return on the dollar? So what are some of the big challenges that people usually associate with going after these mid-sized multifamily type properties, and how have you guys kind of overcome that?
Yeah, it's a great question, because the hardest thing about let's say a 40 or 50 unit property is how do you manage it, right? Because you can't afford on-site staff. So the management fee is, it's a difficult model. You've got to have, you've got to have somebody, you got to have an ability to manage without having people physically there, all the time, because you just can't afford the payroll. So we've leveraged technology to do that. And this has been a big focus for us throughout the past really year and a half, is really understanding the landscape of prop tech, how it impacts multifamily, what's available, and then how can we start to leverage these things to create efficiencies. And so one great example, the first use case that we really set out to solve was, how do you create a contactless leasing process? So how do you create a process where folks can come in through the website, they can sign up for a tour, they can come in and tour, they can tour, they can do a self-guided tour, and then they can, as they're looking at the property and viewing the apartment, they can actually sign up for a lease right there, all digitally, without ever having to come in contact with someone, which became even more important as we got into COVID, right? And just from a safety standpoint. So, things like that have allowed us to create huge management efficiencies. Not having to rely on a property manager or a leasing agent being on site, being able to expand the hours that we're offering tours, and being able to also just control access to the property remotely through an app versus having to go there, with physical keys. And so that's been really a game changer for us. And so one is technology. That's one example. I'd say two is just management strategy. So having an in-house management company like we do allows us to just be more creative and do different things than I think if we were working with a third party. So we were able to work with our in-house management company. They look at things from an investor standpoint. They understand the strategy and what we're trying to achieve. And they understand the value to the investors. And so they're willing to work with us, because that's really what they're for, is to run the property and bring value back to the investors, versus if you're thinking about a third party management company, their goal is to create profit, right? Is to create a margin for themselves. So where we're able to, do things in a more strategic way with the property management that may not be as fruitful for the actual property management company, but it's good for the overall investors. We're just able to do things a little differently as far as managing the way that we kind of position our managers, how we divide management over different properties to manage multiple smaller properties. ability to share maintenance, and the ability to work in kind of a hub and spoke model where we have, we may have a large property in a city and acquire smaller properties around that and really leverage the efficiencies there.
I think that's such a big point, is the fact that by having the intention when you're going to these markets, you're actually looking at purchasing property with the intent to purchase many other properties around that property to be able to leverage those people across each of those individual assets. We've noticed one of our portfolios in Denver that because our partners have that kind of efficiency, because they understand the market, they're able to get deals at a more effective price, and they're able to manage in a way that the institutional investors can't compete with and don't want to. And so the return profile is significantly better than some of these larger deals, at least right now. It's not always the case, right? I mean, large deals are still phenomenal for a lot of reasons. But how do you guys actually do that when it comes to entering a new market or even buying smaller properties in a market you own? Are you literally having folks that are typically in office at one of your larger buildings, the ones who are servicing those smaller buildings around? Or kind of talk to us a little bit on the detail for folks that might be curious.
Yeah, sometimes. So for example, we have a 50 unit property in Lexington, Kentucky. We just purchased. Well, we also have 500 other units in Lexington, Kentucky. We've been in the market for a long time. And so in that one, it is very simple that we're able to, again, use kind of that hub and spoke model, right? Where we've got the mothership, if you will, and then we're able to kind of run things out of there, share some maintenance and realize efficiencies. So that's a very easy one. If we already have a large property in the area, which we have large properties in 10 states, so there's quite an area that we can go and search in, then it's very easy and you see lots of efficiencies. If it's a market where we don't have a large property, like I can tell you, we had in Louisville, Kentucky, we have a 30 unit property. Well, we used to have a 300 something unit property there. And we actually just sold that last year. So now we have this 30 unit property that's there by itself. And I'm confident we're going to acquire more in Louisville because I like what's happening in that city. But, right now, the way that we're doing that is we're just, we're leveraging kind of scattered site management, if you will, where you have one manager who's managing several smaller sites and is able to travel in between. And we're heavily relying on the technology, the smart locks that we've put in place, the cameras that we have on site to be able to control access to the property and keep eyes on the property without our manager physically having to be there. So It's just the efficiencies like that are allowing us to to do these types of things that a lot of operators wouldn't be able to just manage 130 unit from afar.
Well, I think it's really insightful because a lot of people, have been talking about, you can only be able to build economies of scale if you go and get 100+ unit. And that can be a great strategy, but it's also good to see that successful operators are able to put these kind of things together and be able to build a great business. I'm curious, are you guys still searching for larger units, or have you really tailored your focus into this area because you saw an opportunity in the market?
No, it's an additional strategy. So we have multiple deal teams within Birge and Held that are pursuing several strategies. So we do ground up development. We'll do tax credit deals for affordable housing. We have deal teams looking at larger multifamily. We have deal teams looking at smaller multifamily. So there's several strategies that are being deployed under the umbrella of Birge and Held. The one thing I'll say about economies of scale, because that's always the first thing that people bring up of, you can't do small because you don't have economies of scale. That's not true. You're just not thinking about economies of scale in the right way. You're thinking about economies of scale from an individual property standpoint. We have economies of scale on an enterprise level across our $1.5 billion in assets that we have under management. So when we purchase flooring, we're purchasing flooring directly from China for the entire portfolio and storing it in warehouses around the country and then shipping that flooring to the property as it's needed. So, we're not having to buy only 30 units worth of flooring for that 30 unit in Louisville, we're able to pull from our warehouse and send the flooring that's needed. But we're able on an enterprise level to purchase at a much larger scale, which gives us those economies of scale, far beyond what you get from 100 unit or 200 unit, right? Like people talk about economies of scale. And I think that's important to understand. And that's one of the reasons why we're able to run these smaller properties efficiently and create so much value, because we're just able to do it cheaper than the last owner was. So it's kind of counterintuitive. Like you have to be big to go small in some ways.
Yeah, no, I definitely, I can see that. And it's funny how when somebody hears something so many times, and within this community, it's been spoken so many times that 100 plus units is the only way to be able to have that scale of property management. And it can be true. It can be true that at times running smaller properties can have more challenges. There are different types of units in different areas. And those challenges are spoken about because they have some truth to them, but that doesn't mean it has to be a limitation. It's when you go and see an opportunity in the market, you figure out, how can I make this work, and how can I be able to operate these products effectively and efficiently? And that's exactly what you guys have been able to do. So I'm definitely appreciative of that. And a lot of folks are, when they look at a firm like the one that you work in, that you're a partner in, and they hear $1.5 billion of assets under management, they think, wow, that is enormous. That is way bigger than I'm personally in, or maybe even than a lot of the operators that I'm investing in if I'm a passive investor. What have you noticed stepping into a firm with that kind of level of sophistication that is different or that is unique that you just don't see at some of these other firms that are up and coming and growing?
Yeah, that's a really good question. And there's several things. And the way that I was introduced to Birge and Held was as a passive investor. I started investing with them in 2016. And that was how I really got introduced to the firm and to their programs. And all these things impressed me back then as well. One of the probably the most obvious is our ability to do an 8-hour occupied rehab. So we will actually turn a unit while the resident is still there. They leave in the morning to go to work and they come home to a brand new apartment. It's an incredible thing to see. Wow. But we will turn and we can do 3 to 5 to even more units a day in that model. So to give you a sense of the impact this can have, we have a 750 unit property in Indianapolis. And we were able to completely renovate the entire property, including all the exteriors, in 11 months because we followed this 8-hour occupied process. And there's actually a video on YouTube. There's a time lapse where you condense 8 hours down into like 3 minutes. And it just looks like just organized chaos.
We're going to have to get a copy of that, and we'll definitely include it in the show notes for you guys. So I'm excited to see that as well.
Yeah, absolutely. It's cool to see. But just that level of sophistication, because, and people may say, well, why is that? So why is that important? Or the biggest question I usually get asked is, well, don't the people just tear them up before you're able to actually realize value from raising the lease, right? But when you do, so the reason that we started doing this was because we ran into issues doing it the old-fashioned way, which is doing them on turn and having the unit down for several weeks typically, and kind of going through that process. And you run into labor issues, you run into material supply issues. It's a disruption for the residents, right? Because there's construction on site. So if we were gonna do that project the old-fashioned way, that would have been a 3-year project. But we were able to come in and knock it out in 11 months. And through those 11 months, we were able to maintain a 94% occupancy. We didn't see an occupancy dip, which is one of the biggest things that'll kill you as you're going through a renovation. It'll kill your returns. And what usually happens is because we don't raise people's rent right away. You can't raise rent in the middle of their lease, but we'll still improve their apartment. So we modernize their apartment. What often happens is people get used to it. They like it. They like living in that nicer apartment, and then they renew, and they'll renew at the higher rate and feel fortunate to have lived there for 4 or 5 months, at the lower price. And so it's been extremely effective.
Yeah, well, it's so important because one of the big benefits that you're doing there is you're improving the quality of the place that these individuals are living in, but you're able to do that across the entire building instead of having different types of people that have different expectations about what the kind of place they're going to be living in, living together. Right. And so you're able to actually get that done. And by getting it done in 11 months versus taking multiple years, you're actually removing a lot of the risk from the project, because day by day, the project is actually moving forward, and construction can be one of the biggest challenges. One of the biggest risks is that execution risk. And so the fact that you can set that up at that kind of economies of scale. What I'm very curious about is just from behind the scenes, are you actually moving these people's stuff out of their apartment? Are you tearing out cabinets? Like, how is this actually happening?
Yeah. So typically what we'll do is, we'll have, depending on the scope, we'll have them move like all of their stuff into like one bedroom, or we've actually had them have it moved out into like a pod before, if we're doing everything. But yeah, you'll see in the time lapse, like floors, cabinets, countertops, appliances, really just about everything except paint, because limited, just having paint dry and things, it can take a couple of days. So we really do just about everything except paint in that 8 hours. And when we do paint, it typically just becomes a 2-day thing. So it really doesn't expand things that much. But yeah, it's actually moving the folks' stuff or having them move it. There's a lot of, so it took about 5 or 6 years to work out this process, honestly. And because of all those logistical things that you would think have to occur, the coordination of the subs, it is kind of like a ballet as they go in there, and everybody's got to be on point. It's got to be closely managed. So it's not something that came overnight, for sure.
Yeah, well, that's huge. Well, this has been phenomenal. We've made it to the growth rapid fire round where the questions are quick, but your answers don't need to be. So let's talk about success. How would you define success, and what is success to you?
Man, that's a good question. Success to me is just having the freedom to live the life that I want to live, to work on the projects that I want to work on. To work with the people I want to work with, and just as important, not work with the people I don't want to work with, and have the ability to spend the time with my kids and my wife that I want to, and be the kind of husband and father that I always wanted to be. And I mean, that was it was the main catalyst that really set me off from leaving my career as a management consultant and pursuing real estate. What was that time freedom?
Yeah, that time freedom can be such a big driver. And so habits, what are some of those keystone habits that have been able to lead to that foundation of success that you're building?
Yes. So just setting goals, prioritizing, and being very clear on what's important, I think is extremely, extremely important. So goal setting, I think meditating. So I meditate daily. I'm a big Miracle Morning follower. I think it's a great way to start the day. I think it's a great habit to develop. And I think those things, as far as what has led to my success, the other I guess you kind of call this a habit or a routine, but just the networking and creating connections. And I mean, that has propelled the connections I've created, have propelled my career, light years beyond probably where I should be at this point. Really have started investing in real estate about 5 years ago. So I think just creating connections and very intentionally going out and networking and putting yourself out there.
Yeah, I think that's some really great advice. So inspiration, what impact have mentors made on your life, and how do you recommend others go and find great mentors?
Yeah. So kind of right along the lines of connections, right? Mentors have had a huge impact on my life. So, for example, Birge Held, right? I started there as a passive investor. Just built relationships with them over time. Tag Birge, the Birge of Birge Held. He's become a close mentor of mine. He helped me as I was kind of coming up doing my own deals, and then offered to have me come on and join their firm and work under their umbrella and on their very advanced platform and be able to do my deals on their platform. So been very beneficial. I have other mentors, in several other areas, whether it's kind of podcasting and marketing and just life. And so mentors have had a huge impact on me. I think, how do you go out and find mentors? Well, I have a mix of paid and unpaid mentors. So the paid mentors, that's pretty straightforward, right? You can find somebody who's been successful and has a program and sign up. And those are great because I think paid mentorships are great from an accountability standpoint, because it's something that you've had to put some skin in the game on, and they're there to really help hold you accountable. For unpaid mentors, I think you've got to seek to serve or seek to add value first. I mean, that's how I try to approach things. It doesn't have to be grand gestures, but I'll give you an example. So with Tag, he was gracious enough to meet me for lunch. One day I reached out to him. He was willing to have lunch with me. We start talking. I'm thinking, man, how can I add value to this guy's life? Right? This guy, has everything, runs this giant business. He's doing fantastic. But I had just read the book by Principles by Ray Dalio. And so I thought it was a great book. So I bought a copy. I wrote a nice letter and I sent it to him. And a couple of days later, Tag calls me up and he's like floored. He's like, "Thank you so much for this. This is such a thoughtful gift. Like, I've been meaning to read this." And so it doesn't have to be big things, but I just think trying to add value first to those mentors or people that you'd like to have mentors, I think is the way to approach it. Don't just go asking to pick their brain. I think that's what a lot of people that are very busy and successful, they get a lot of that and they really don't like that. And so you need to differentiate yourself in some way.
It's one of the worst things I think you can actually send to somebody is, "Hey, let me just pick your brain." It's like,
it's a huge turnoff. It's a huge turnoff.
But that's some great advice. Well, this is phenomenal. It's been great diving in, getting to know you even better, and sharing some amazing stuff with the audience. Where can people find out more about you or get in touch?
Sure. So I'm a pretty easy guy to find. You can go to kentritter.com, and that's kind of my home base. You can check out the podcast there, my blog. I've got some freebie materials for folks that are interested in especially passively investing. Also my podcast, Ritter on Real Estate, where we're focusing on how to make better investing decisions. And other than that, on social media, I'm very active on LinkedIn and on Instagram. So, I'm easy to find if you want to track me down.
Love it. Well, it was really great talking with you, and thanks so much for being here. And I definitely look forward to the next time we get to hang out.
Thanks, Stephen. It was great talking with you, man.
Today's episode is sponsored by Von Finch Capital. If you're interested in investing alongside me in the same type of real estate opportunities that I personally invest in, then head over to Von Finch Capital and join their private investor network. You can do so at vonfinch.com/invest. Join me on that next deal, and I look forward to seeing you on the inside. Thank you for listening to the Investor Mindset Podcast. If you like what you heard, make sure to rate, review, subscribe, and share it with a friend. Head over to theinvestormindset.com to join the Insider Club, where we share tools and strategies from the top investors and entrepreneurs on how to take it to the next level.